Greetings, everyone. I'm David Darst, here to give you a recap of the month of June 2024. Welcome. This past month, there were a number of important developments on the economy, inflation, the Federal Reserve's positioning, and, of course, the artificial intelligence enthusiasm. Let me just recap those for you now. On the economy, as you may recall, the fourth quarter was very strong of last year. It was up 3.4% in real terms, annualized. The first quarter, we just got the revised number for the third estimate of the first quarter, and it's coming in at 1.4%. The second quarter, that's what we're just ending now, here at the end of June. The second quarter, according to the Atlanta Fed's GDP Now model, is running at 2.2%. Now, you may have seen that it was 2 weeks ago, 4%. So you do see this slowing that's going on in the economy. Continuing jobless claims. We watch that very carefully. They are the highest that they've been in 30 months. You've got 1.83 million people continuing claims for unemployment insurance. New home sales have been showing a sharp decline, and pending home sales also a sharp decline. So the housing sector is somewhat in a stalled position right now. The consumer confidence, now the consumer is such an important component of the economy. Consumer confidence is slowly softening. Retail sales, as you may have seen, ex-automobiles and gasoline, they were up only 0.1% for the month of May. And that compares to April being revised downward to minus 0.1%. The jobs numbers, people basically cited those as evidence that things are going fine. The jobs numbers for May were 272,000. They were reported early this month, early in June, 272. However, the household survey showed a decline of 408,000 jobs. Those two are often contradicting one another, and here's an example of that, and we will see who is right. The ISM manufacturing and the ISM services numbers came in. They were 48.7 versus April, 49.2. So you had this continuing softening in the manufacturing sector. You had the ISM services, which I'm very happy to report, got back up over 50, which means it's in expansion territory. It was 49.4 in April, May, 53.8. However, both of those, the ISM services and the ISM manufacturing, showed a decline in employment figures, in the underlying components of those two data points. The May lead indicators were down 0.5%. They were reported in June. April was down 0.6%. You may recall, we've talked about this before, it has been down now 25 of the last 26 months. And that the next issuance of the lead economic indicators will be on Thursday, July the 18th. We are basically, that's one of the reasons we do believe that there will be this continued economic softness that will lead, then we get into the topic of the Federal Reserve. The Fed Fund futures markets. Right now, the Fed says they're going to be, the median projection is one interest rate cut between now and year end. The Fed Funds futures markets are projecting two interest rate cuts, one in most likely in September. The next meeting, as you know, is July 30th, 31st. There's only an 11% chance from the Fed Funds futures markets positioning, only 11% odds of an interest rate decrease of 25 basis points. When you get to the September 17th, September 18th meeting, the odds rise to 63%. You've had one or two governors say that it's most likely that the cut, now this is the Fed talking now, not the Fed Fund futures markets, that there's a likelihood of one interest rate cut between now and year end, and it'll be in the fourth quarter, which would, if he's right, that would rule out the September 18th cut. Right now, we're okay with the likelihood of a September 18th cut. Then you have November 7th, which will be 2 days after the presidential election. Right now, the odds of at least a 25 basis point cut are 75% chance. And of course, December, 94% chance. So we are in the camp that there'll probably be two cuts. The Fed is right now basically saying more likely one cut. When you cut through all of this, the month of June, the S&P 500 was up 3.5%. That follows 4.3% in May, and it's up 14.5% this year. You contrast that to the equal weighted index. So 14.5%, it's so heavily concentrated with these big technology companies and the artificial intelligence, NVIDIA, that giant that makes the graphics processing unit chips. The NASDAQ is up 18.1%. It had a big month in June, 6% gain after 6.9% in April. The Russell 2000 was down 1.1% after being up 4.9% in the month of May, and it is up only 1% this year. So you have this big disparity, this concentration that's going on with the top market cap company, NVIDIA, represents 31% of the S&P 500's gain this year, and the top 5 represent over 50% of the gain thus far this year. Everything good seems to us to be priced in. You had, by the way, oil, $81.54. It was up 5.9% for the month of June, and that compares to a decline of 6% in the month of May. So you had a reversal of May's decline here in the month of June, and oil is up 13% thus far this year. The S&P this past month was up 3 weeks before declining in the last week of the month just slightly. It's 27 points below its record. The index is at 5,460. So it's 27 points below its all-time record, and it's made 31 records thus far this year. We are in the camp that the IT, the information technology sector within the S&P 500, there are 64 companies in that sector. They are trading at 33.5 times earnings, next 12-month earnings, after a 43% gain that started in October of last year. So you have the market quite elevated. It's being pulled up by this specific technology sector, and specifically within that, the artificial intelligence excitement. The 10-year Treasury closed at 436. It was down 18 basis points in May, and then another 15 basis points in June. Thus far this year, the 10-year has risen 48 basis points from its close at year-end last year of 2.88%. All of this, putting this together, we think it's time to have some liquidity, but at the same time, it's time to really begin rethinking the traditional model of 60% stocks, 40% bonds. You really need to have assets and asset categories, asset classes in there that give you return, that give you volatility management, volatility reduction, that give you diversification, that give you balance. And there we come to private equity, private credit, private real estate. We thank you all for listening today, and we look forward to catching up with you very soon.